Hi and Assalamualaikum. My name is Nik Nurshahira Sabri. I am from class A4 AC1105M. I want to present the answer for the question 1. Okay, let's go through the question. On 1st July 2015, Evergreen Berhad acquired a building at a cost of 2 million. The economic useful life of the building was estimated to be 50 years. Evergreen Berhad had been using the building as its staff training center. The fair value of the building on 1st July 2016 was 2.58 million. It is the policy of the company to measure its property, plant and equipment using revaluation model and investment property using fair value model. Accounting year end on 30th June. So the question required discuss the accounting treatment of the building for the year ended 30th June 2016 and 30th June 2017. Okay, the cost of building on 1st July 2015 was 2 million, and then less the accumulated depreciation, which is 2 million divided by the 50 years and time with 1 year, and we got 40,000. And then carrying amount on 30th June 2016 was 1.6 million. Then the fair value on 1st July 2016, 2.058 million. And we got a surplus or revaluation of 98,000. And the Jim carrying amount on 1st July 2016 was 2.08 million less the accumulated depreciation, which is 2.058 million divided by the remaining years, 49 years and time with 1 year. We got 40,000. And the carrying amount on 30th June 2017 was 2.06 million. The accounting treatment on 30th June 2016. On 1st July 2015, the building used for staff training center can be recognized as property, plant and equipment at a cost of 2 million. The depreciation of 40,000 will be expensed off in SOPL. The carrying amount of the building as at 30th June 2016 is 1.96 million. And the accounting treatment on 30th June 2017, on 1st July 2016, a surplus arising on revaluation of 98,000 will be credited to the asset revaluation reserve since the company adopt revaluation model for its PPE. The accumulated depreciation of 40,000 will be eliminated against the carrying amount. The fair value as at the date is deemed to be carrying amount of the building. The depreciation of 42,000 will be expensed off to SOPL. Thus, the carrying amount of the building as at 30th June 2017 is 2.016 million. Okay, for the question 1B, required assuming on 1st July 2016, Evergreen Berhad had decided to lease out the building to tenant under operating lease, and the fair value of the building on 30th June 2017 was 2.158 million. Discuss the accounting treatment of the building for the year ended 30th June 2017 and support your answer with the journal entries. Here is the answer for question 1B. It is the same as the question 1A, and here the Jim carrying amount on 1st July 2016 was 2.058 million, and we compare with the fair value on 30th June 2017 which is 2.158 million, and we got a gain on fair value of 100,000. So the accounting treatment on 30th June 2017. On 1st July 2015, the building is treated as investment property since there is change in use from owner-occupied property to investment property, and the building is measured at a fair value of 2.058 million. The carrying amount of PPE on the date of transfer is 1.96 million, and the accumulated depreciation of 40,000 will be eliminated against the carrying amount. Any difference between the building's carrying amount and its fair value is treated the same way as a revaluation in accordance MFRS 116. Hence, 98,000 surplus arising from the revaluation of the owner-occupied building is credited to asset revaluation reserve. The fair value of 2.058 million is deemed to be carrying amount of the investment property. There is no depreciation as the date since the investment property used in the fair value model. There is gain on fair value of 100,000 and will be recognized in SOPEL. Okay, the journal entries. On the 1st July 2016, we need to debit accumulated depreciation of 40,000 and credit MFRS 116 PPE of 40,000. And then we need to eliminate the accumulated depreciation. That is why we debit the accumulated depreciation. And then we debit MFRS 140 IP of 98,000 and credit asset revaluation reserve of 98,000. And on 30th June 2017, we need to debit investment property of 100,000 and credit SOPEL gain on fair value of 100,000.
Question 2. Vista Berhad bought an asset at a cost of 75,000 ringgit on 1st July 2016. On 30 June 2017, similar asset had been actively traded in the market at 85,000 ringgit. The cost to sell is 2,500. The market value of the asset is 85,000 ringgit as at 30 June 2017. Question A. Assuming the asset is cattle red for its meat, explain the appropriate accounting treatment for the asset for the year ended 30 June 2017. The asset is recognized as biological assets under MFRS 141 Agriculture as it meets the recognition criteria. On 1st of July 2016, the asset is measured at its initial cost of Rm 75,000 ringgit. On 30 June 2017, at the year ended, the market value increased to 85,000 ringgit. Biological assets are measured at fair value less cost to sell, so the carrying value of the asset as of 30 June 2017 is 82,500. Comes from 85,000 less 2,500. 2,500 is the cost to sell of the asset. There is a fair value gain. The gain of 7,500 from 82,500 less 75,000 is recognized in the SOPEL as income. 82,500 is the carrying value of the asset and 75,000 is the cost of the asset. Journal entries to record the above transaction. On the 1st of July 2016, debit biological asset 75,000, credit bank 75,000. On 30 June 2017, debit biological asset 7,500, credit SOPEL gain in fair value 7,500. This is the initial cost of the asset, and this is the gain on fair value. B. Assuming the asset is equipment used in research activity which has an estimated useful life of 5 years and the cost model is adopted. 1. Explain the appropriate accounting treatment of the asset for the year ended 30 June 2017. The equipment is recognized as property, plant and equipment under MFRS 116 as it meets the recognition criteria. On 1st of July 2016, the asset is measured at cost 75,000 ringgit. This is the initial cost. The asset is depreciated over its useful life of 5 years. Since company adopted cost model, depreciation is measured using cost less accumulated depreciation. Depreciation for the year ended 30 June 2017 is 15,000 ringgit, which is 75,000 divided by 5 years of the useful life, and to be expensed in the SOPL as depreciation. On 30 June 2017, the carrying value of the equipment is 60,000 ringgit, from the 75,000 less 15,000 ringgit, the depreciation for the year. It will be recognized in the SOFP as PPE. Prepare the journal entries to record the above transaction in B1. On the 1st of July 2016, debit property, plant and equipment 75,000, credit bank 75,000, initial cost. 30 June 2017, debit depreciation 15,000, credit accumulated depreciation 15,000 ringgit, and debit research cost 15,000 ringgit, credit property, plant and equipment 15,000 ringgit.
Okay, now let's take a look at question 3. Krizen Berhad acquired an asset on 1st July 2016 for 800,000. The useful life of the asset is estimated to be 50 years. Fair value of the asset given by an independent valuer on 30 June 2017 was 980,000. For subsequent measurement, the company adopts the following model for its asset: investment property, fair value model, property, plant and equipment, revaluation model, and intangible asset cost model. Question A. Discuss the accounting treatment of the asset for the year ended 30 June 2017. Assuming the asset was a building rented out to Krizen Berhad's subsidiary company. From the question, we can see that the company has the new fair value of the asset on 30 June 2017, which is 980,000. So, let's take a look at the answer. On 30 June 2017, as the building was rented out to Krizen Berhad's subsidiary company, hence, the building is classified as an investment property as per MFRS 140. As the company adopted the fair value model for its investment property, thus, the carrying value of the building is Rm 980,000. The gain on the fair value of 180,000 that can be calculated from the new fair value minus the cost of the asset will be treated as income in SOPL. Question B. Discuss the accounting treatment of the asset for the year ended 30 June 2017. Assuming the asset was a building provided by Krizen Berhad as a housing facility to its foreign workers. On 30 June 2017, the building that is provided by Krizen Berhad for its foreign worker as a housing facility is classified as a property, plant and equipment as per MFRS 116. The company adopted the revaluation model for its PPE. The building is measured at the initial cost of 800. As the building is being revalued on 30 June 2017, there is a gain on revaluation amounted to 180,000. This gain on revaluation will be credited to the revaluation reserve. As the company adopted the revaluation model, we must calculate the depreciation of the building and also the carrying amount. The depreciation on the building is 39,200, which is 980,000 divided by 15, which is the useful life of the asset, and multiplied by 2 years. This depreciation will be expensed off. The carrying amount of the building is 940,800, which is the revaluation amount of the building minus by the depreciation. Question C. Assuming asset above was a license and on 30 June 2017, its recoverable amount was 700,000. Question C1. Calculate the impairment loss. To calculate the impairment loss, we must cost less with accumulated depreciation to find the carrying value and compare it with the recoverable amount. The first one, cost of 100,000 minus with accumulated depreciation 32,000, then the carrying amount is 768,000. After that, we must compare it with the recoverable amount, which is 700,000. The carrying amount is higher than recoverable amount. Thus, the impairment loss is 68,000. Question C2. Prepare the journal entry on the impairment loss. The first journal entry is to debit the impairment loss of 68,000 and then credit the building of 68,000. That's all. Thank you.
Okay, now we move to question 4. On 1st July, the question is, explain the accounting treatment for transaction. So for first question, which is accounting treatment, before we do the journal entries, we must calculate this. This is the journal entries. First, debit accumulated depreciation.
Question 5. A property development company, Damai Berhad, had completed the development of 20 units of shophouses on 1 Julai 2015. Each unit cost at RM750,000. On 30 June 2017, the market value of each unit was 1 million ringgit. The policy of the company is to measure its investment property using the fair value model and property, plant and equipment using revaluation model. The financial year ends on 30 June each year. Question 5. A property development company, Damai Berhad, had completed the development of 20 units of shophouses on 1 Julai 2015. Each unit cost at RM750,000. On 30 June 2017, the market value of each unit was 1 million ringgit. The policy of the company is to measure its investment property using the fair value model and property, plant and equipment using revaluation model. The financial year ends on 30 June each year. Assuming the 20 units of shophouses are for sale in the ordinary course of business, on 30 June 2017, there were 3 units remain unsold. Question number 1. Identify the MFRS used. MFRS used is MFRS 102 inventories because of the shophouses are held for sale in the ordinary course of business. Question A2. Explain the accounting treatment of the unsold units in accordance to the relevant MFRS. Three units remain unsold. On 30 June 2017, the 3 units remain unsold will be recognized under MFRS 102 inventories at its cost of Rm 2.25 million, which comes from 750,000 times 3. 750,000 is the cost of one shop house. Inventories are recognized at the lower of net realizable value and cost. Since the NRV of the 3 unsold building is Rm 3 million ringgit, comes from 1 million ringgit times 3 units, which is higher than the cost, so the NRV will not be chosen. No amount is to be written down in the SOPL. Question B. Assuming that 17 units of the shop houses are rented out and the other 3 units are occupied by Damai Berhad, each unit could be sold separately. Explain the accounting treatment for the shop houses for the year ended 30 June 2017. The 17 units rented out is classified as investment property MFRS 140, while the 3 units occupied is classified as property, plant and equipment MFRS 116, as they meet the recognition criteria of each of the MFRS. For the year ended 30 June 2017, 17 units under IP is measured at the market value of Rm 17 million, which comes from 1 million times 17 units. There is fair value gain of Rm 4.25 million, comes from 17 million minus 12.75 million. When there is a gain on fair value, it will be recognized in the SOPL as income. No depreciation is recorded under fair value model. As at 30 June 2017, the carrying value of the shop houses is at 17 million, recognized in the SOFP under investment property. As at 30 June 2017, 3 units measured under PPE will be recognized at its revalued amount of 3 million ringgit, which is 1 million ringgit times 3 units. There is a surplus on revaluation of 750,000 from 3 million less 2.25 million to be recognized as income in the SOPL.